Welcome back to Renegade Investor Academy. Now, with the caveat, this is being recorded on the 4th of March, the very next day after Rishi's budget announcement. Clearly we haven't had much time to analyse it, but let me try and give you some first impressions of what was in yesterday's budget statement. And I'm going to look at this in 6 different categories. I want to look at the kind of overall state of the nation from the data that he was sharing, what's happening in the world of business, the changes he's making to our personal tax situation, this whole area of ESG and the green agenda that's become so significant during the pandemic. I want to talk about the housing market and finally about levelling up. But I also want to talk critically, and I think probably most importantly, about what was not in yesterday's statement, because I think that could end up to be the most important stuff. So overall, he confirmed what I think we all kind of knew and feared, that our GDP fell by 10% in 2020, and that is the worst performance since 1709. And those of us who can remember 1709 know that that wasn't a great year. So that's how bad 2020 was. Now, of course, everyone's talking about a coiled spring, about excess savings, about a huge bounce back as we start to come out of the whole lockdown situation. So the latest figures, they're looking at something like a 4% uplift in GDP this year and a whopping 7.3% in 2022. Now that is great. It still doesn't get us back to where we were pre-pandemic, but those are very solid numbers. What I'm concerned about is the numbers beyond that, because in the 3 more years that they've given the forecast for, we're looking at 1.6, 1.7% growth. That is anemic. That is really, really low. So, this is not exactly the brave new sunlit uplands of Brexit Britain that, perhaps we were hoping for. He's told us that we're looking at a 407 billion cost for the pandemic so far, which, it's a big number. The deficit this year, 355 billion. Now, it's worth remembering when you hear figures like deficit, the deficit is, if you like, the profit and loss account of this year's accounts for the UK PLC. What it doesn't tell you is the balance sheet. And the balance sheet is where all the other debts from the previous years are accumulated. And our balance sheet is now getting to be over £2 trillion. And, we're having to start to adjust from billions to trillions these days. I guess it'll be quadrillions before we know it. But 2 trillion is our national debt. Now, there is no way that's ever going to be repaid other than through inflating it away. So to me, that's another little nudge in the direction of deliberately induced inflation and the reduced purchase power of sterling to get rid of that massive national debt, which has been increased by 355 billion during 2021. And as we look out to a couple of years' time, by 2023, our total debt will be 97% of our gross domestic product. And that's getting us into some quite dangerous territory in terms of the sort of shakier countries and the shakier economies on the planet. Once you start getting north of 100%, you're getting into some fairly uncharted waters. It's not a place we really want to be, but we are massively and very quickly heading towards 100% of GDP in our national debt. So overall, I'd have to say, I think it was an honest assessment of the state of the nation, a couple of good years of growth ahead, followed by some very mediocre growth indeed in the middle part of the decade, and a really substantial increase to our national debt that is going to be very hard to overcome with this level of growth. There's only 2 ways. We can either become more productive and grow the economy, or we have to inflate the debt away, or we default. That's the third choice. But clearly, we're not going to grow our way out of this debt looking at these numbers. It's only going to happen by stealth and by inflation. And stealth is a word that I think really does sum up a lot of what Rishi Sunak announced yesterday. If we move on to the business world, there's been a lot of activity and a lot of funding and a lot of stimulus in the business world during the pandemic. Many have fallen down cracks. The sole company directors, people who are recently self-employed have really struggled in this time. But there has been, even compared to other countries, a substantial amount of stimulus. So he announced a further $5 billion in what he calls restart grants to help business get going again. There's also a new loan scheme that replaces Bounce Back and CBILS loans and covers amounts from $25,000 up to $10 million. I've yet to see the qualification criteria for those, but at least there is some new funding there. I think maybe the most inspired introduction in yesterday's talk was this idea of what he calls the super deduction. And if you invest in productive assets, and I still need to look and see what he means exactly by productive assets, then you can reclaim more than the actual cost. For every £100 you spend, you can claim back 130 against your tax through that super deduction. So this will go a long way to overcoming one of the biggest issues in British business in recent years, which is underinvestment. One of the problems has been that people have been around and people have been quite cheap because wages haven't gone up in real terms for about 40 years. So businesses have often thrown people at the problem rather than investing in new technology that would genuinely improve productivity. What we should now see coming forward is an increase in productivity by new investment in this super deduction. Of course, on the downside, what we've also had is this announcement about corporation tax, which is going to increase by about 30%, up to 25% from 19%. Now, that's a pretty significant rise. Now, if your business makes less than 50,000 profit, it's only going to stay at the 19% level. But apparently there are going to be some intermediate levels that I haven't seen yet between 19 and 25%. You know what really shocked me about this part of the announcement was, he said the 25% rate will only affect the top 10% of companies who are making more than 250,000 a year in profit. So what he's saying, if I understand that correctly, is that 90% of the 5 million plus companies in Britain are making less than £250,000 profit. What does that tell you about our dependence and our reliance on the SME sector, the small and medium enterprise sector, that must drive the vast majority of Britain's economy? So for all these big names you see in the FTSE 100 and even the FTSE 250, there are a relatively small number of these companies that are making even £250,000 profit. So for me, that was one of the most startling statistics to come out of this. And if anything, re-emphasizes our real national dependency on these kind of small businesses. They're also freezing the level of the VAT exemption, which is just one of many things that's been frozen for a 5-year period, which is really now bringing us into the personal tax area, where I want to talk about the fact that these allowances have been frozen through to 2025. This is a favourite trick of George Osborne when he was Chancellor. It's called fiscal drag. So what it means is you don't actually effectively incur an immediate increase like changing the percentage rate of tax, but by leaving the allowances the same and allowing for the inflation we've been talking about, effectively you're going to be paying more. So 1.3 million additional people will now be drawn into paying income tax, and another million will go from being basic rate taxpayers to being higher tax rate taxpayers simply through routine kind of pay rises over the next 5 years, and the fact that their salaries might be inflation linked, but the allowances aren't, so suddenly you're going to click over into that higher rate tax band. Perhaps the most egregious of all is the fact that once again the inheritance tax band is going to be frozen. That has been frozen since 2009, and it's now going to be frozen until 2025. So more and more families, more and more estates will be drawn into the inheritance tax trap if they have not made proper planning and proper provision in the years before they shuttle off their mortal coil. What it all means is that already, as a result of yesterday's announcements, Britain's tax burden will be at its highest since Roy Jenkins was Chancellor in a Labour government in the 1960s. That's when the Beatles wrote their Taxman song. It's when sports and showbiz people used to have to go abroad for a year to be tax exiles. We are heading back into that kind of territory. And of course, the pensions lifetime allowance, which has already been decimated in recent years, is also going to be frozen for another 5 years. So yeah, again, that just over 1.03 million, that's not going to change. And remember, there's some really punitive tax penalties if you start paying in more, or if your investments perform well and you go above that lifetime allowance, then suddenly you're going to be in big trouble and paying a lot of tax. We were expecting, perhaps, after all the leaks, to see capital gains tax go up substantially. It hasn't happened, but they have frozen the allowance of just north of £11,000. Again, one assumes for 5 years. So all the inflation increases in your assets in that time, they're going to be sucked into the capital gains tax trap. So not a great budget in terms of the personal tax position. It's all about fiscal drag, all the allowances being frozen. It avoids them breaking a manifesto pledge around increasing tax rates and so on, but effectively it is a tax increase just by stealth. What about the whole kind of ESG green agenda? Well, yeah, that was kind of mentioned in there. What surprised me was, given this focus, he's not changed the fuel duty. I thought he could have pretended to be a very green chancellor and hiked up the fuel duty on petrol and got away with it. But he's chosen not to. I think this is a part of the whole kind of looking after their people in the red wall agenda, perhaps further north, and some very effective lobbying from backbenchers. But I was really surprised he didn't take a chance to hike the fuel duty. What he has announced are green recovery bonds, trying to get that kind of wartime spirit of we're all in this together and let's have these kind of green-related bonds. I've no idea what they'll invest in. I can guarantee the returns will be lousy. Probably, if you look at what national savings have done recently, they're going to be below even our current benign rates of inflation. So I'm certainly not going to be rushing to put money into those recovery bonds, but they are a little bit of greenwashing for the government going forward. Weirdest announcement of all, I thought, was that the Bank of England's mandate is going to be amended to include net zero emissions. Now, quite what a central bank has got to do with pollution and green stuff and environmental stuff and emissions, I can only imagine they're going to come up with some kind of penalties for big companies that don't comply or something. I just thought that might be more in the perhaps the Department of Trade and Industry, whatever they're called these days, or even the FCA. But for the Bank of England to be involved in that, really not sure where that's going. But maybe there's some kind of nod towards a central bank digital currency that's going to have some kind of rewards for green behavior in the whole kind of behavioral economic sphere. Interesting. There's something behind that that's more than I can see at the moment, because that's very weird. Housing. Once again, the government cannot leave the property market alone. They continue to manipulate it. They obviously regard housing and house prices continuing to rise as an essential plank of their leadership platform. So we have two major announcements. The extension of the stamp duty holiday, despite all of Rishi's protests in the early months that he wasn't going to do that, it has now been extended for another 3 months. That in itself, as I've reported to you on in the past, has already increased prices by as much or more than the actual stamp duty saving. So it's become self-defeating because people simply hike the prices up to effectively take back the 15,000 or whatever that people are saving on stamp duty. So that's been extended to keep the bubble inflating. And we now have this 95% mortgage guarantee from the government. So this is all part of a very, I think, dangerous trend of the government and the central banks ending up owning so much of our society. I talk more about that in the Renegade Investor Revolution that's kicking off this week. But for me, the more government gets involved in owning these things, the more central banks get involved in owning assets, the more we are on a slippery slope away from a free market capitalist economy. So for me, what this means is continued manipulation of the housing market. I think I rest my case in that the house builders' stocks and shares have rocketed up today as we record this. They obviously see this as very good news for the housing sector. And finally, on the sort of levelling up agenda, this has always been a big thing, of course, since they won the election. 250 very unfortunate civil servants in the Treasury Department are going to be forced to relocate from the Westminster bubble to the sunny climes of Darlington. Now, as somebody who comes from those parts, I can only sympathise with them. If you're watching this and you live in Darlington, of course I don't mean it. We've also got the announcement of an infrastructure bank in Leeds, which is going to have 12 billion to give away on worthy projects. I assume they're going to have a kind of a green tendency towards them, but that's a kind of, again, government buying assets and government impacting, I guess, construction and energy related projects. There's also the announcement of 8 free ports, which are going to have better customs terms, I think easier planning conditions. And essentially, it's kind of just another way of reviving some of the underdeveloped areas of the economy. Teesside is one, East Midlands Airport is another, Liverpool is another. So hopefully that will cause some economic activity in those areas. I think for me, perhaps one of the most disappointing aspects of all this was the lack of clear vision for the future. Where does this government want the country to be in 2030? What do they want it to look like? For me, perhaps the most disappointing thing of all was this hike in corporation tax. I'd really hoped that they were going to set out a vision for Brexit Britain that was going to be something like the Singapore of Europe. As you have seen from one of my previous broadcasts, financial services weren't even covered in the Brexit agreement, and we're already losing lots of business to Holland and Germany and all the rest of it. So this was a chance to really say, we're going to be a low tax, low regulation country, business friendly, lots of foreign direct investment and all the rest of it. There's a visa scheme that will help bring in key technical staff for companies. That was a good idea, getting over the immigration restrictions. But overall, I felt it lacked vision. And this is probably, it comes from the top, because Boris lacks vision. He bumbles around from one day to the next. I have no idea what he wants this country to be, what he wants his legacy to be as Prime Minister. Certainly there was nothing coordinated that came out of this. It was a collection of measures that are, in some cases helpful, in some cases damaging, but no overall vision or framework. But here's the thing I want to leave you with. In some ways, you might be thinking, after all the pre-budget leaks, that we dodged a bullet. No massive hike in capital gains tax, no reduction or removal of higher rate pension relief, and so on. Don't count your chickens yet, because recently Rishi has also announced a whole series of tax reviews kicking off later this month. And I think this is the strategy. Let's start the pain today in March. Let's get people really knowing that there's a big issue that's going to have to be addressed and all the rest of it. And then let's really refine our tactics for what we're going to do post-pandemic. This has all happened in the middle of lockdown. So I don't think he was going to put his most controversial, most painful things in place while we're all still under house arrest. I think if you look at their roadmap out of this over the course of the spring and the summer, they're going to look at these reviews on capital gains tax, on pensions, on whatever else. They're all going to report back in time for the autumn budget. And I suspect that's when we're going to get the real pain. So what I think this does is buy those of us who've got businesses or assets or significant portfolios, perhaps as much as 6 months, to get our house in order. And that could mean everything from selling a business, selling a property portfolio, moving offshore, getting a new residency somewhere. We've got some time to start getting our thoughts together before the real pain comes later this year. So for me, this is a kind of stay of execution, not totally happy with it, particularly, as I say, in terms of the corporation tax agenda here. But for those of us private individuals with assets that we're slightly worried about the taxation regime on, I think it buys us a little bit more time. So I hope you found that useful. We'll be covering this obviously as it evolves over the coming weeks and months. But for now, thanks very much for watching. I'll see you again soon on the next Renegade Investor Academy. If you'd like to see some previous episodes, click here. Don't forget to like the video, subscribe to my channel, and ring the bell so you don't miss out on any future episodes.